Our next guest says that the Treasury refunding plan has opened the floodgates to buy all assets. Let's bring in Spring Advisors CEO Andy Constan. So you've been listening to our conversation where we just said this market environment now seems to be a green light for both bonds as well as equities. And that's exactly what you did, Andy, in your portfolio. When did you do that? And how long do you think does this trade last?
Yeah, so Melissa, the first thing I did today was look at the quarterly refunding announcement at 8:30 and found that the bonds issuance for today, for this quarter, was being kept the same. And it's all about bonds, long duration assets that the private sector has to buy. But importantly, next quarter, they're only increasing the bond supply by 10 billion. 3 months ago when you had me on, they increased bond supply for this quarter by 160 billion, and that caused the S&P to fall 8%, 10-year yields rise 100 basis points. And so today, the supply is still heavy, but the rate of change has gone from 160 billion to only 10 billion. And asset prices have cheapened dramatically. And so given that combination of there's still plenty of supply, but less supply, and very cheap asset prices, I think assets are cheap now, and assets can rally in maybe a false dawn through year end. But, that's sort of the way I put together the supply issue.
So so you're long stocks, and in terms of being long bonds, is it time to go long duration at this point? Or do you see value? Do you see, a move higher in all parts of the curve?
Yeah, so actually, the thing I find most interesting is the rally in the 2-year. That's the one that didn't make sense to me. But in terms of long duration, I was short 30-year bonds. I covered them right on the open. And then they've rallied 15 basis points or so. And I think they have another 15 to 20 basis points to go. So I do think the 30-year is interesting. The 2-year rallying doesn't make a lot of sense to me for many of the reasons you all mentioned, which is if bonds and long-term bonds and stocks both rally, the Fed's going to have to hike more, and that's going to hit the 2-year. So I think the 2-year rallying is the most odd bit of this day today. Powell was hawkish. The QRA relieved some of the pressure on long-term assets, and yet the 2-year rallied such that there's about 95 basis points of cuts priced into 2024, and the Fed only expects 50.
Why did you think Powell was hawkish? We just had Steve Leisman on, who, endured the whole press conference live and in person, and he walked away with a dovish message.
Yeah, I think basically the bottom line is I think he was right down the middle of exactly where he has normally been, which is focusing on inflation, not convincing the market that there could be one more hike, but we're going to pause for a long time. And I didn't get anything new. Steve's the expert, so I defer to him.
Andy, it's Karen. Thanks for being on today. Nice job getting out in the morning of your shorts. What do you think is more attractive now, the equity markets or the bond markets?
Well, I think they both can rally 2 to 3%, maybe from here, maybe to 4,400 on the S&P, so maybe you get 4%. But, we still have the same problems in that we do have $720 billion of quantitative tightening to deal with each year. We do have it's likely that the Treasury is going to have to increase issuance again. So I don't think we're going to run away on the upside. And, there's lots of problems. But at the same time, at this stage, the duration overhang has been lifted. And that should lift assets, call it 3 to 5%.